I went to Mumbai the other day, and the first thing that I saw after landing was an ad for a wedding loan. A wedding loan. We have gotten to that point where you need to borrow to marry a person. 70% of iPhones sold in India are bought on EMIs. And in the first time in Indian history, the number one reason why people are taking a personal loan is to travel. Not for a medical emergency, not for education, but a holiday. India's household debt has nearly doubled as a share of GDP in the past 9 years, from 26% to 42%. That's still way below the US at 70% or South Korea at 91%. But here's the thing, it took America decades to get to those numbers, and India's covering that ground in a matter of years, not generations. But what does all this actually mean? Are young Indians borrowing too much? Or are we just getting access to more credit to actually fulfill a need that was unmet over the years? Before you panic about the numbers, you need to understand what you're actually measuring. Your grandfather borrowed too, but he just borrowed from a money lender down the street at an exorbitant 30% interest rate. No paperwork, no record, no data. In rural India, 34% of all credit still comes from informal sources. Money lenders, chit funds, and friends and family. This debt never showed up on any statistic, any record. It was all very informal in that sense. And then India opened 500 million Jan Dhan accounts. They call it the Jam Trinity. There's Jan Dhan, there's Aadhaar, and then there's mobile. And suddenly, lending also went digital. More than 350 fintech apps, all competing to give you a loan. Approved in under a minute. For any amount up to 50,000, you don't even need basic paperwork. You don't even need to talk to a human. So a part of what looks like a debt explosion is actually just a visibility shift. A decade ago, less than 25% of Indian adults were credit visible, meaning that the banking and the overall lending system could not even see them. But today, that number lies between 55 to 60%, which means that borrowing that was always happening is now just happening in a more transparent manner and also on platforms that can actually track it. And that is genuinely good. People who are initially paying 30% or exorbitant interest rates are now under the formal credit line, which is anywhere between 12 to 18%. A farmer in Bihar now does not have to pledge his land to borrow 10, 15, 20,000. So in many ways, all this is actually really good, where credit is finally reaching beyond metros into smaller cities and into the hands of rural Indians.
नील झालं, नंतर 60,000 रुपये कर्ज काढलं, ते पण नील केलं ना. मग आता 3-3.5 एकर जमीन खरेदी केली.
तुमच्या नावावर आहे?
हो,
तुमच्या नावावर?
माझ्या स्वतःच्या नावावर.
But that's not the whole story, because total borrowing too has also genuinely increased. And more importantly, what people are borrowing for is something we really need to dig deeper and question in many ways. Section 2. What are we actually borrowing for? There's a huge difference between borrowing to build something and borrowing to consume. A home loan is a loan to build an asset. An education loan, at least in theory, builds earning potential and earning power. A business loan builds income. But 55% of Indian households today are using loans on non-housing. Credit cards, personal loans, and BNPL. It's all going towards things that depreciate the moment you buy them. Phones, flights, clothes, things that you really don't need. EMI and loan obligation now eat a significant chunk of household spending. And the consumption, that's growing faster than income. And that gap between what you aspire to do and your actual income is actually being filled by debt. The average new borrower in India is 28 years old. Most fintech borrowers are under the ages of 30. A lot of them aren't juggling just one loan. They're juggling multiple loans, 2, 3, 4 loans at a time. And some are just taking new loans just so that they can pay off the old ones. And at some point, that stops becoming access to credit and just becomes a debt cycle. I also want us to take a moment to think about who is on the other side, the lenders. For a policy bazaar, every loan originated is revenue. For a credit bee, every disbursement is actually a fee. The incentive structure of the entire lending ecosystem is built around volume. The more you originate, the more you earn. And there's a whole generation of fintech companies who are building smarter underwriting, which basically means better ways to assess people. Companies like KaleidoFin, which is backed by Bloom Ventures, uses alternative data to assess credit worthiness and to allocate more money accurately. And that's real innovation if you can identify who's genuinely credit worthy using UPI history, using GST filings, using spending patterns and analyzing that instead of just your classic CIBIL score. You can now lend to people whom the traditional system would have rejected because your overall way of analyzing creditworthiness has gotten better. But that's also a very fine line. If the underwriting is tight, financial inclusion is done right, more people get access to credit, lower default rates, and in that process, everybody wins. But at the same time, the minute the underwriting gets loose and the pressure from platforms and distributors is also high to push out newer loans to people who otherwise should not be borrowers, that's when you get NPAs. And we have seen exactly how that looks like.
Credit crisis. The booming industry was supposed to help India's poor climb out of poverty. Now it's on the verge of collapse in one of the nation's largest provinces.
In 2010, the microfinance sector in Andhra Pradesh collapsed. SKS Microfinance, the poster child for the industry, they're just IPO'd at a $1.5 billion valuation. It was also oversubscribed 13 times. Sequoia, Morgan Stanley, George Soros, everybody was in. They were also opening 2 new branches a day, training 500 loan officers a single month. But there was no credit bureau for microfinance. Multiple lenders were giving loans to the same borrowers. The average indebted household in Andhra Pradesh had 9 simultaneous loans. And that goes back to incentive structures, where agents, they were paid on disbursements and the amount of loan that they could push out, not on repayment, not on quality. And when the borrowers could not pay, the collective turned coercive. At least 54 committed suicides were linked to MFI collection pressures. The state government shut it down overnight with an emergency ordinance. Repayment rates collapsed from 100% to below 20%. SKS Finance lost 96% of all its stock value. Microfinance gone. The entire sector nearly died. This lesson wasn't that microfinance was bad. It was that growth without discipline creates exactly the crisis that it claims to prevent. The structural parallels to today are hard to ignore. No unified views of BNPL and digital loan stacking. Just like 2010, no MFI credit bureau. Even today, just like in 2010, borrowers are using new loans to pay off the old ones. 27% of microfinance today follows the same pattern. The mechanism is identical. The medium has changed from a village agent to a phone notification. But the balance between access and discipline is everything. So is India actually in trouble? Are we headed towards a financial crisis? Or are these just the pains and the teething problems of growth? That is part 2 of this 2-part series.